Welcome to Magnifi Plus, where we help you invest with intelligence, meaning that with Magnifi, you can now do more than just trade stocks. You can search, you can discover, and invest in the ideas and values that are most important to you using our revolutionary machine learning software. As 2022 demonstrated, just investing in growth companies for capital gains is highly volatile and risky. Never before has it been more important to consider dividends and international investments as part of your overall investing strategy. I'm Nicole Lapin, former CNBC, CNN, and Bloomberg anchor, and your host for today. It feels as if we have all just lived through this past week before, when Silicon Valley Bank, a lender to some of the biggest names in technology in the world, became the largest bank to fail since the '08 financial crisis. Are we experiencing another crisis in confidence in our financial system? Joining me today are Tim Seymour, CIO of Seymour Asset Management, and Kevin Simpson, CIO of Capital Wealth Planning. Tim, let's start with you, as you're on CNBC every day, living through this. What is your take here?
First of all, Nicole, great to be here with you and on Magnifi. In 2008 was a crisis of confidence that really was the banking side. Remember when there's different phases of every, call it a bear market in markets, and the phase when you get into a liquidity crisis and a credit crisis are very different than the growth scare. So it feels a lot like that. In that you wake up one day, there's a new headline, there's a new entity that's potentially under the shroud of again, market confidence, and in many cases maybe it just is that shroud. But you can make an argument that the consumer's in a very different place, the housing market's in a very different place. But each time they say history doesn't repeat itself, it rhymes. So let's see.
Yeah, there's definitely lots of deja vu, MVS's, financial crisis. Kevin, how is this affecting your investing in general, but specifically in the financial sector?
Yeah, I echo Tim's comments that certainly Friday, Saturday, and Sunday morning felt very, very reminiscent of those horrible days back in '07, '08, and '09. But the news that came out Sunday was refreshing, and I feel like protecting the depositors was the right call. But to your point, Nicole, also the contagion, just even the fear of it, is something we need to keep an eye on. Hopefully this is an isolated event based on the clientele that they had and just the unique business nature that they were involved with. We tend to look at very mega cap, large cap financials, and we do own Goldman Sachs and we do own JP Morgan. On one hand, JP Morgan's been a tremendous beneficiary of new inflows, new accounts, and a flight to safety. But on the other hand, you have to assume that there's going to be regulations that come as a result of this. Also, when you look at a yield curve that's inverted to the extent that it is, it affects profit margins on loans. And you have to also look at what other banks may have on their books as far as 10-year treasuries. And when they mark those to market, are they exactly as secure as maybe we thought a month ago? So I think it's going to affect financials and we have to pay close attention. But for us, it's about best of breed, and we'll feel confident that owning best of breed's the absolute way to play it here.
And Tim, what do you think this means for what the Fed does? Goldman came out, of course, saying they don't think that the rate hike is coming, but they're kind of the lone ones out there. What's your take?
I don't see how they can stop. At least to do 25 bips here. And I think if you look at Fed fund futures, which by the way are gyrating like a yo-yo. You're too young to remember yo-yos, Nicole. But when I grew up, there were cool things like Whammo, company Whammo. Remember those, Kevin?
I remember. I have one in my drawer.
Right. So Treasury yields and Fed fund futures are not supposed to gyrate like yo-yos. You had a 2-year that's in the last 5 days moved 125 basis points. It's crazy, and I think on some level the Fed can't change their tune overnight, and I think the Fed has to if we don't squelch inflation, we're in trouble. And if we follow a path where the Fed put, and by the way, I just want to tell the audience out there, investors, be careful. This is not a Fed put. Putting some type of deposit insurance, and while I could play Bye Bye American Pie, and this is the death of American capitalism and things like that. That's different than a Fed put. And I think it would be a massive mistake for the Fed to reverse field here. And I think the market's gotten the Fed wrong multiple times in the last year and a half. So, we saw with those CPI numbers yesterday. I think if anything, inflation shows that services remain sticky, rent remains sticky. We know goods prices have peaked, but I think the endemic and the deep-rooted parts of inflation that we have to get rid of are things that the Fed needs to keep fighting. So I think they have to go. I know the world's different today than it was a week ago at this time. And I think at some point the Fed does need to address liquidity conditions. But right now, financial conditions are still a lot looser than they were, say, 3 or 4 months ago. And inflation hasn't necessarily reversed field.
Kevin, do you agree?
Yeah, 100%. I think the situation with Silicon Valley Bank took the 50 basis point hike off the table. But the idea that they can't continue to raise rates is unacceptable. 6% is massive inflation. It's going to take a long time to get it to 2%. And as much as we all collectively want them to pivot, we want them to lower rates because we know how productive that is for equities. They're going to need to continue to raise rates, even in the wake of what's happened. But 25 basis points seems like the right move at this time.
Yeah. The Wall Street Journal, Tim, just reported that the liquidity in Treasury trading is drying up, which of course hasn't happened since the first few days of COVID. Could this be one of the reasons that there's this flight to safety with gold and even Bitcoin?
For sure. And just to be clear on liquidity conditions, especially from the primary dealer community who support the government bond market and the Treasury market, which is the biggest market in the world, et cetera, hasn't been the same since 2008. All right, let's just be clear. Liquidity is very different today than it was 15 years ago. In terms of the move in Bitcoin, the move in Bitcoin tells me a couple of things. Anyone that's been a Bitcoin advocate and is a picks and shovels kind of a gal, I don't know if you are, Nicole, but or guys and gals, Bitcoin, this is why you own Bitcoin, right? And the rally of 37% or something over the last 4 days is part of that existential support for Bitcoin. It's also the other part of that is if you think the Fed is done, you're buying Bitcoin. And I think Bitcoin is kind of on steroids what gold is. And I'm not here to debate whether Bitcoin is a safety store of value, whether it is really truly providing this kind of a backstop. But that's the thesis. And for gold, if we're in an environment where there's stagflation and you've effectively seen the worst of the Fed, the worst of the dollar, and the worst of rates, you want to buy gold here. And just to be clear, gold was much maligned over the last 18 months because people said, boy, shouldn't this be the environment to buy gold? Well, remember, until October of 2022, the dollar was rampaging 27 to 30% over just 18 months. That's not a great environment for gold. I think gold actually not only held serve, but traded really well. So look, I'm long gold. I'm long the GDX. I believe that actually these asset classes are going to continue to work.
Kevin, how does that affect your investing strategy? Why do you think it's so important to take a look at what's going on with Bitcoin and gold, but also pay attention to dividends and basics and managing risk?
You bailed me out with the second part of that question, Nicole, because Bitcoin isn't really my forte. We look at companies that generate EBITDA, that have earnings and pay dividends. And when we're looking at the commodity space, I tend to look at it from the peripheral and more of a watcher than an expert in the crypto space for sure. But for us, the dollar is so important, as Tim correctly pointed out. I mean, you can't look at gold when you've got the U.S. dollar on a rocket ship ride. So for me, we've tried to invest in gold miners from time to time when we've seen good dividends, good revenue streams. So that is something that we're exploring for the portfolio. We don't have any exposure at the moment, but I feel like there are opportunities for sure. And as an equity investor, it's something you have to pay very close attention to.
Tim, I think you have a little bit of a different perspective, right? You don't solely invest in dividends, not completely your jam. Why do you think it's important to incorporate some of this other exotic stuff, international investments, into your portfolio?
I would frame it this way. As someone that's been investing internationally my whole career, And for the audience to understand, I actually work with Kevin and advise Capital Wealth Partners on the IDEVO strategy. So an ETF that is seeking to find companies that are delivering above average dividend yields. In fact, there's a hurdle to get through, and then there's an option overlay that raises that dividend yield. But it's about finding some of the biggest, best companies in the world that are here today and here tomorrow. And as somebody, my background, look, if we're talking about 2008, we can also talk about 98 and long-term capital and the other great crisis. I was living in Russia at that point, and I was an emerging markets investor at the start of my career. And to me, investing internationally, you can find companies that are running for cover, just like community banks and regional banks during a period of liquidity crisis, or you can find companies that are actually the pristine balance sheets that actually are bulletproof in terms of their core business and are not necessarily reliant on the dynamics and the cyclicality of the global economy. So I love finding those kinds of companies, and I would just say that the setup right now is clearly in favor of that. And it's in favor of that not only because I think the dollar, it's not just an 18-month run that I know the dollar, if you're watching this today, it's the Ides of March. I mean, the dollar's having a big rally and it looks like a real risk off day. The dollar will rally during those periods, but I think the dollar's largely peaked. And I think that's great for multinationals. That's great for international companies, especially those that are paying divs. But I again, back to companies that you seek out that are not only just paying higher divs and have better payout ratios, and we can talk about those sectors where that's going on. Energy probably at the front of the list. But part of this is finding companies that are just generating free cash flow. I mean, part of the dynamic for the stock market dealing with higher interest rates over the last 2 years, and certainly the last 18 months, has been about high multiple companies, long duration bets, where cost of capital, as it changes, completely changes that investment thesis. When you're talking about companies that are paying divs and are generating free cash flow, like old school, I think, first of all, stock picking becomes a lot more effective and important. And I make an argument that largely the market that we invested in over the last couple of years, at least before the Fed started to get involved, was very much just about buying high growth. And I think the world has changed, and I think it's changed for the foreseeable.
Yes, it's changed since the days of the yo-yo and the Floby. I'm glad you guys.
The frisbee, right. The yo-yo. What else, Kevin? Mattel Electronics football. I'm trying to think of the things. Yeah. Anyway.
I'm glad you guys kumbaya on that. Kevin, after you invest in these companies, love to just double click on the dividends piece. That when you see the companies that invest in, they pay, grow dividends, how do you then sell? How do you know when it's time to sell? Are there any indicators that you keep an eye out for?
It's so fun having conversations about selling stocks, because buying stocks is easy. It's fun. Who doesn't love buying a stock? Because you get to kind of watch it go up, and that's awesome. Selling a stock is really hard because it's a two-step decision. Not only do you have to decide to leave a stock that you've researched, selected, have owned and watched, then you have to find something else to put it in, and then there's this psychology of looking at each one and kind of comparing your decision, post-sale. So we try to bring a rules-based process into everything we do, how we buy stocks, how we select for the portfolio, how we write covered calls. And then to your point, Nicole, how we sell stocks, which isn't easy, even for us as professionals. But there are 4 reasons in which we would sell a stock. The first is if they cut or suspend a dividend. Everything that we talk about in our strategies is dividend growth, and making sure that they have free cash flow and earnings to support it. But if a company's stepping back from that dividend or ceasing to pay one, then they're no longer a candidate for our strategy. So the last time we sold a stock for that reason was during the height of the pandemic. We had been shareholders of Disney. They cut the dividend. We sold the stock and never looked back. The second reason we might sell a stock is if it gets called away. We do utilize tactically covered calls in the portfolio, and sometimes we'll have a stock that gets sold into strength or called away. It's a sell discipline. It's somewhat unique to us, but it's the second reason we would sell a stock. The third is from a risk management and a budgeting system, where we might love a company, but we really want to make sure that we maintain portfolio size control. So we have a 5% maximum on any stock that we own. And if a stock's doing really well and it grows to a 7 or 8% weighting, we'll use old school rebalancing, trim it back to 5%. And the last reason is for relative underperformance. If we have a stock that and the share price is performing poorly and it's underperforming by 15 or 20% versus its peer group, its sectors, its competitors, it doesn't mean that a stock's down. It's not a stop loss. Sometimes companies go down, but if it's down relative to its peer group, then we have to acknowledge that something's wrong under the hood. Something that we did in our research wasn't right. And we can live to fight another day if we can just get rid of it and take a small loss. And that's what we do. We can reset, digest, we can always buy something back, but you don't want to own something that's falling to perpetuity. So a sell discipline is incredibly important. And I would argue in some cases, it's even more important than how you make stock selections and portfolio construction.
Some people are wondering, though, if they should even be investing in stocks when you can get, more than 5% with no risk in bonds. Tim, why do you think equity risks are so important when you can see those types of fixed income returns?
Well, I think if you want to, first of all, be clear on asset allocation today versus a year ago, and let alone 3 years ago, it's great that there are yield instruments out there that fixed income and credit and is a very viable place to be on some level. It's exciting. For people that think that they're a genius for putting money into 3-month treasuries, I mean, be careful. There is at some point an opportunity cost. I do think there's an opportunity also to be buying great companies during difficult periods where, as they say, you make the most money when things go from terrible to just bad. And I think this is, again, if you're buying a company like Novartis or Diageo or Unilever or Tenaris, these are all names that are in IDEVO. These are all, again, world-class companies. Tenaris is the largest tubular pipeline manufacturer. No one's ever heard of this company, probably. I bet they have. But my point is that, and it's an Argentine company. So you think, why would I want to own this? I mean, they have $5 billion of cash on their balance sheet. They're growing right now about 18%. I realize it's been a sweet spot for the energy sector. But finding these companies that also, there's opportunities through dislocation in markets. And I just feel like it's been really easy for people to be really bearish during a time like this. I go on TV every night and I'm surrounded by people who have a very bearish view sometimes. By the way, not necessarily, I'm not pointing fingers at anybody. I'm saying sometimes it's a lot more topical to be bearish. Sometimes it sounds a lot more intellectually interesting. And I think you have to be careful to suddenly just say, let me default to treasuries here. Look, if I told you that the market was going to have a 40% drawdown or a 30% drawdown, or even a 20% drawdown in the next 6 months, then I think, clearly on Monday morning, you can look back and say, I should have had my money in 3-month treasuries. But I get the fact that asset allocation, if you gave me a 7% 10-year, I would lock in some long-term money at that, and that would be part of an asset allocation. And depending on who I was, for me, that'd be great. But I think you have to look at this opportunity to find great companies. I think you're going to see healthcare outperform. You're going to see pharma outperform. You're going to see some consumer staples, not all. Some of them have gotten really expensive. But I think there are places here to be investing and not just say, because bond yields are higher, I need to run away from equities.
Yeah, Tim, we humans, we have this negativity bias. It's our thing.
Not you. You're always a ray of sunshine, Nicole. But there are those during a difficult time like this that I think it's just easy to be bearish. And I think there are companies that are going to really perform in this environment.
Kevin, are you bearish? I mean, what do you think about the opportunity cost that Tim was talking about? What's the downside to not investing at this time?
Well, first of all, I'm strategically bullish. So I always think that the companies that we invest in are going to increase and appreciate over time. As long as they have earnings that are increasing, even at a more modest rate, their share prices will react over time. And to the idea of putting money away for 6 months and just getting back in when things look better, the crystal balls over there in the same drawer as the Whammo yo-yo, it doesn't always work because we know Murphy's Law is around, and trying to time the market is a fool's errand. So for us, we look at these opportunities to build positions, to own great companies. We're getting dividends coming out, in our case, mostly on a quarterly basis, that are just very robust, continuing to increase. We're able to write covered calls, harvest some of this volatility that we fully expect over the near term, but we're compensated, we're paid to wait. And when you look at a 4 or 5% treasury, the CPI came out yesterday at 6%. So the inflationary pressure still isn't there to get me too jazzed up about the fixed income market. Now, to Tim's point, if you had a 7% 10-year treasury, that asset allocation might make sense. But for me, we're equity investors, and we feel like you can generate far better total return after inflation on a risk-adjusted basis, owning blue chip stocks, best of breed companies, free cash flow, dividends, dividend growth, and the covered call piece helps to buffer a little bit and smooth out that ride.
You know, Kevin, you've overperformed dramatically over the last year. You've seen a lot of cash inflows. Is there enough capacity to keep growing, do you think?
Yeah, we have intense and tremendous capacity because we invest in S&P 100 large mega cap blue chip stocks. Also, iDevo that Tim and I are working on together is just another infant strategy that takes all of the wonderful attributes from Devo and brings it internationally. So you're able to really allocate, if you need to allocate internationally, I can think of no better way to do it.
Tim, the iDevo is an international, is an ETF, of course, of international dividend paying stocks. What do you think? We touched on it before, but I'd love to double click on what do you think makes it a unique offering?
So Nicole, when you grew up, were you listening to cassette tapes or CDs or vinyl?
Oh, both.
Both. All right. And how about vinyl? I mean, you were.
I'm past the vinyl time.
But the reason I bring up this is I learned yesterday that vinyl is now outselling CDs, and vinyl apparently has had a renaissance, and it's pretty exciting. And I bring all this up to say international investing is kind of like the vinyl record. It kind of had gone, people had forgotten all about it, and the renaissance that I think we're about to be on is one where people will recognize that one of the reasons why international underperformed or wasn't as big of an allocation, and again, we're talking about U.S. investors. We're not talking about people that live in the countries where we might be investing. But I just think if you wanted high growth tech exposure, where else were you going to invest? You were going to invest in the U.S. You were going to invest possibly in Taiwan Semi, a few Chinese companies. But for the most part, you were investing in the U.S. And there was very little reason to invest internationally, especially at a time when you saw what the dollar was doing, especially at a time when there was an argument that some of these places were, I think, undergoing fiscal adjustments. I think if you look at the international landscape and structurally the way markets are set up for the next 3 to 5 years, I think there's going to be a lot more allocation internationally. I think there should be a lot more allocation internationally. I think the days of 30% of the S&P, not of the NASDAQ, but of the S&P being 6 stocks that are tech companies from the U.S. is over. I don't think we're going back to that. And I think if you're allocating capital right now, having exposure to companies that have great balance sheets, great businesses, are world-class in their sectors is kind of like listening to Jackson Browne's running on empty, which I know a lot of people watching this broadcast love some of those tunes. So I think about an environment where also you can make an argument that look at since October where the dollar peaked, and I know it's up today. The German DAX or their S&P is outperformed the S&P by 30%, not 3%, not 6%, but 30%. And is basically within 5% of all-time highs over the last couple of days. European stocks have legged down like U.S. stocks. But I just think that international markets look a lot more interesting, both structurally, I think also because high multiple investing and growth at any cost and zero cost of capital is something that is like the 8-track tape. I think it's in Kevin's Camaro.
Listen, it comes back. It always comes back. The bell bottoms, the low rise, it's the vinyls.
Bell bottoms. I never had bell bottoms. No, I had bell bottoms.
Wide leg pants.
It was a Chevelle, Tim, but what's not going to come back are zero interest rates and free money.
And so, Kevin, you just said in the middle of that zero interest rates are not coming up. I mean, everybody looked like a genius when there was zero interest rates, right?
Yeah, it's easy to make money over a ticker symbol, and it's going to go up. So from the standpoint of active management coming back into vogue and fundamentals and earnings and valuations mattering, like we're at the point now where I think it's completely back into we've got the wind at our back, and we're in a position now to really stick with best of breed. And And the idea that we're looking at being able to replicate the success that we've had domestically now with an international version of our strategy is just really exciting. And I think history will prove that our timing was perfect. However, all of us know that there was some luck involved with our timing and when we started the strategy. But that recipe of best of breed earnings, dividends, covered call writing, all of it, I think, for the foreseeable future, while we have a pulse in the bond market, while interest rates are at 3, 4, 5% and not at zero, is going to lend itself to the ways in which we invest money, both here and abroad. And I couldn't be more excited.
I would love to get to some predictions, but before we do, Kevin, the financial sector, the banking area, of course, taking a beating right now. Do you think there are buying opportunities? Things are on sale.
You want to buy when there's blood in the street, right? So I mean, I think there are opportunities. We tend to stick with best of breed. So we own Goldman Sachs and we own JP Morgan. Both of them have very low single multiple PE ratios. Doesn't mean they can't go lower. It doesn't mean that the effects that what we're seeing in the regional banks isn't going to hurt financials across the spectrum, at least temporarily, especially if there's higher margin requirements, government intervention. Lots of things can cause some problems here over the short term. So we've been writing covered calls on both of those, which have helped buffer a little bit of the drawdown. We're keeping an eye on these positions as opportunities to add to them. But for right now, I think we're going to be in a wait and see mode to kind of get a situational retest from the Federal Reserve, from the government, from the FDIC to kind of provide some guidance for the larger banks. But if you're going to be investing, that's where you want to be because that's where the cash is.
Tim.
Hi.
I know we like going back in time. Let's go forward in time, shall we?
Okay.
What are some predictions for the rest of 2023? Where do you think we're going to top out with interest rates? And generally, where do you think we're going?
I think we've largely tapped out or topped out and with interest rates. I think we're probably going to see the Fed stay higher for longer, and therefore, that in and of itself is its own restrictive policy, and on some sense, really is like them raising rates. I think they do need to pause at some point here. So I think, and I do think that the bond market is going to continue to challenge the Fed and what we've seen in long rates. Look, the jury of proof right now is for the 10-year to get back and hold above 350. But I look at structural issues in the rates markets that tell me we're not going back to a 2% 10-year, even if we're in a recession. I don't think anytime soon, because first of all, I think there is so much more issuance. There are technical factors that will keep rates higher. I think there is diversification, but there's always been that dynamic for other central banks. But I think you've got a case where we do have structurally higher inflation. I do think you have a case where there's going to be, everything from the death of globalization to the onshoring to the energy markets to, I just think inflation is higher and that ultimately the bond market will recalibrate. I understand the long end is sometimes what the Fed can't control. They control the short end, or so they kind of do right now. So to answer your question, I think we're going to be, at the end of the year, I think we're going to be very similar to where we are right here.
And do you have any thoughts? I know that Kevin is too good for the baby financials and the regionals, but do you have any thoughts on that sector?
Yes, I do think some things have changed in the last few days that I don't like. As someone that has a position in money center banks, including Citibank, JP Morgan, Bank of America, I think everybody's cost of capital just went up. I think everybody's regulatory pressure just went up. As I said last night, that grinding sound, I said this last night on Fast Money, is the sound of banks tightening their lending standards. And I think none of this is good for the banking sector. I think the headwinds on multiples, I think are I think they're topping out here. I think for the foreseeable, I think there's a regulatory pressure that comes with, hey, we're now bailing out all depositors. If you're Citibank, you can't have a 4.5% div yield. And I think there are questions here. I also think that there will be opportunities, and we know that right now the bigger getting bigger. The fact that we're looking at, or we were last week, in the last week we were looking at uninsured deposits versus insured deposits. What analysts and even banking analysts really were looking at those figures in the past. So I mean, I think there's a heavy scrutiny. I'll also go on there and say, SVB. What were these guys doing with a lot of their securities portfolio? They were a leveraged mortgage REIT. Okay, and that's not what most banks are doing. And we all also know that the regulatory environment around some of the regionals and the stress tests that they passed or would have passed were not necessarily the same standards we held the money center banks to. So I think regional banks obviously have a lot more regs coming. I think the money center banks, unfortunately, still have a bullseye on their back, even though I think for the most part, their business models are very different than what they used to. They have de-risked. Their balance sheets have at least been built for suffering 1, 2, 3 standard deviation sigma moments. Sorry for the hedge fund terminology here. So I like banks here. I don't think you need to own them like wholesale, like saying this is my place to go in and buy them, but there will be people that make money here.
Okay, Kevin, where do you think we're going to top out interest rates, multiples? Also, how do we get this crisis of confidence back on track? It's really hard to convince folks that they didn't see a ghost when they just saw a ghost.
Yeah, I mean, that how eloquent is that? But the answer that we're both giving you today is a lot different than the answer I think we would have given you a week and a half ago. The good news is we're closer to the end of the Fed rate hike cycle, whether it's going to be the 25 basis points in March and then they pause for a long time, or if they say, you know what, to heck with it, we're going to go another 150 basis points. We're taking this terminal rate to 6%. We're tamping down inflation, and we don't care the damage that we do in the interim. Even in that worst case scenario, it's 150 basis points, which pales in comparison to the 450 that they've already raised. So the markets have been taking a punch and coming out somewhat resiliently. But I think that the 6% terminal rate is probably a bit of a stretch now based on everything that's happened within these regional banks, so that maybe another 25, another 50. And to Tim's point, the pause is the problem. What the market wants to rally on for the real next bull market is rates coming down, which they will do. The Fed will lower rates. It'll be for one of two reasons. It'll be because that they've navigated this plane perfectly, and we had this amazing soft landing and everything's great, and they can take pressure off and bring rates down because inflation's back at 2%. That's a possibility. It's never happened before, but it's a possibility. The other example could be that we go into a recession, that they drive the economy into something that's going to be economic compression. And now at some point next year, they need to lower rates to re-stimulate that economy that they put this pressure on. In either case, you're going to have a Fed that's lowering rates and a stock market that's going to move higher. And it's our job to be investing and allocating in advance of that so we can take advantage of that next leg higher.
Guys, it's great reminiscing with you. Great looking at our crystal balls with you. So many flashbacks. Just leave us with like a Zeppelin ditty.
Well, I mean, look, I hate to go straight to when the levee breaks, but it feels like we're going to test it.
And you're going to stick with the Led Zeppelin for the international side. I'm going to go with the Doors as an American investor, as a U.S. investor, and we're going to be riders of the storm.
Kevin, Tim, thank you so much for joining us.
See you later.
All right, now let me show you how you can use Magnifi's research capabilities to help you analyze investment opportunities. This is very cool. We talked about the ETF Divo, D-I-V-O. So let's use Magnifi, which is like Google for investments, and research Divo. So take a look at this. I just typed in Divo, D-I-V-O, in the search bar, and here's what we get. Starting at the top, this is the views menu, which defaults to assets. And here we see that Divo has $2.7 billion. If you click here, you can now access other valuable pieces of information. Here are a couple of my favorites. If I select top holdings, let's say, I can hover over each shaded area to see the holding percentages. I could also then go and select yield, which is particularly relevant, of course, for an ETF like Divo because it's focused on dividend income and is much higher than other results on the page. If I were to click the fund itself, DIVO, Magnifi then gives me a lot of other information. So see here, it's a description of the fund. And then right beneath that, I can see the fund's price, performance over time. Here's actually my favorite section. These are the key stats. I can see the fund's performance compared to its category. It shows return, risk, and fees. And this is also adjustable by time period. So there you go. Some great information today. And most of all, such a great way for all of you watching to make better informed investment decisions. For more information on investing with intelligence, visit us at magnifi.com.